Hey there. So you know how tax loss harvesting is usually seen as a year-end thing, right? Well, guess what? It's not just for December. It's a whenever you need it kind of strategy. Picture this. You've been putting off dealing with your investments all year, and now you need to offset some gains in 2025. No worries. When you sell a not-so-great investment in a regular brokerage account to score a tax-saving loss, you might run into trouble with the wash sale rule. Ever wondered if the wash sale rule applies to the cryptocurrency losses? We've got to scoop on that too. It's tax time made friendly. Alright, let me break down this tax magic for you. So here's this thing called the wash sale rule for federal income taxes. And it's a bit like a tricky dance with timing. Here's the deal. If you sell some stocks or mutual fund shares and then within a 61-day window, 30 days before and 30 days after the sale, you go and buy basically the same thing, the IRS considers it a wash. They think, hey, no tax loss for you. But wait, it's not all doom and gloom. Even if your hoped for tax saving loss gets denied, it doesn't just vanish into thin air. Nope. Instead, it tags along and gets added to the tax basis of the new securities you bought. Let's get into an example to make it clearer. Imagine you bought 2,000 shares of Technocorp on July 4th, 2024 for $50,000. The market takes a nosedive and you decide to bail out on December 15th, 2024, selling those shares for $30,000. You're thinking, sweet, a $20,000 loss to offset my gains. But hold on, you really like Technocorp. So on December 22nd, 2024, you buy back those same 2,000 shares for $31,000. Now here's the twist. The wash sale rule kicks in and your expected $20,000 loss is put on hold. But fear not, that denied loss doesn't disappear. Instead, it plays hide and seek in the tax basis of your newly acquired Technocorp shares. So their basis becomes $51,000, $31,000 cost, plus $20,000 disallowed wash sale loss. Now, when you eventually decide to part ways with these shares, that extra basis will either tone down your gain or pump up your loss for tax purposes. See, it's a bit like playing the long game with the tax man. Alright, buckle up for another round of tax saving strategies. So, you're itching to sell a security for that sweet capital loss, but you're not ready to part ways with it completely because you think it's going to bounce back. No worries, we've got some tricks up our sleeves to dodge that pesky wash sale rule. First up, we've got the double up strategy. Here's the lowdown. You snag the same number of shares of stock that you're planning to sell for a loss. Hold on to them for a chill 31 days, then sell off the original batch of shares. Ta-da! You've scored a tax-saving loss sale and you're still holding on to the same number of shares, ready to ride the wave of future appreciation. Let's dive into example number 2. You've got a 2025 capital gain dilemma, and you want to sell those 2,000 Big Pharma shares for a tax-saving loss. But hey, you're not ready to say goodbye. So on December 21, you grab 2,000 more Big Pharma shares. Now you're free to sell the initial batch for that sweet loss anytime after January 21, 2025 without triggering a wash sale. Genius, right? But hold on, there's another sneaky move in example 3. This one's a bit more budget friendly. Instead of buying a bunch of actual shares, you can opt for a relatively inexpensive call option on the stock you want to sell for the 2025 tax loss. Purchase that February 2025 call option for 2,000 shares on December 21, 2024. Now, you can sell your 2,000 Dandy Candy shares after January 21, 2025 to grab that 2025 loss, all while sidestepping the wash sale. Just a quick tip, make sure to wait at least 31 days before selling those Dandy Candy shares because, according to the wash sale rule, the call option and the actual stock are considered pretty much the same thing. Sneaky, but totally legal. The world of taxes, always keeping us on our toes. Now, here's a head scratcher for you. What happens if you sell stock for a loss and your better half decides to jump in and buy the exact same stock within that tricky 61-day window? It seems a fair question, right? Especially if you and your spouse are filing jointly and are considered one big happy taxpayer family. Surprisingly, your beloved Internal Revenue Code and the IRS regulations are silent on this particular situation. You'd think they'd have it all spelled out, but nope, nada. IRS Publications 550 gives a nod to the wash sale rule if your spouse snags substantially identical securities within the forbidden 61-day period, but conveniently leaves out the details when it comes to separate returns. It's a bit like a tax mystery novel without a final chapter. Now brace yourself for another twist. If your controlled corporations decide to get in on the action and grab substantially identical securities within that same 61-day period, guess what? Yup, the wash sale rule applies, and get this, it traces back to a 1935 court decision, way before the modern wash sale rule even existed. Talk about vintage tax drama. But there's more. What if you dip into your tax-favored retirement account, your trusty IRA or 401k, to snacks of substantially identical securities. According to IRS Revenue Ruling 2008-5, you're in hot water. Buying those securities within this forbidden 61-day period triggers the wash sale rule. And here's the kicker. You can't boost your IRA's basis with the disallowed loss. The IRS says that loss just goes up in smoke. Now, here's where it gets a bit fuzzy. Revenue Ruling 2008-5 draws parallels to a 1933 court decision involving a taxable trust, but conveniently forgets to highlight that an IRA has a tax-exempt trust. Go figure. So, here's the bottom line. IRS regulations have been around since 1956, but they leave us hanging when it comes to those related party scenarios. We say take those IRS positions with a grain of salt. But hey, when in doubt, chat with your tax pro. They're the real superheroes in this tax maze. Alright, let's dive into the crypto tax maze. It's like navigating uncharted waters, but don't fret, I've got your back. The IRS currently tax cryptocurrencies as property, not securities. There's a big win. The wash sale rule doesn't mess with your mojo if you sell crypto at a loss and jump back in shortly after. No sleepless nights over a wash sale woes. Your crypto loss, whether short-term or long-term, is a breeze. It's a chill vibe, similar to how the IRS handles foreign currency losses. But here's the catch. It might take an act of Congress to switch things up. Picture this. You ride the crypto roller coaster, take a $100,000 hit, but also rake in $100,000 in stock gains. Good news, you can offset those gains with your crypto loss, even if you rejoin the crypto party soon after. Just a heads up, losses from selling crypto-related securities like Coinbase stock dance to a different tune. They're under the wash sale rule. Stocks are in, but cryptocurrencies are playing a different tax game. Stay tuned for twists and turns in this crypto tax saga. Change is the only constant in the tax world, so keep those ears perked up for updates. Capitalizing on capital loss is a go-to tax planning move, and you can deploy this strategy whenever the opportunity arises to offset gains. However, the key rule here is to consistently outsmart the wash sale rule. In this piece, we delved into the workings of the wash sale rule, unveiled a couple of crafty tactics to bypass it, highlighted some eyebrow-raising positions taken by the IRS, and dropped the bombshell that cryptocurrency losses are exempt from the wash sale rule. Yes, you heard it right. Crypto gets a pass. So, the main takeaway is this. When it comes to tax-savvy maneuvers, harvesting capital losses is a timeless strategy. Just stay one step ahead of the wash sale rule, and you'll navigate tax season like a seasoned pro. Hope you found this video helpful. If you did, give it a thumbs up and subscribe for more. Take care.